I wouldn't want to speculate on things, but yeah, can you hear me?
Yeah, sure, go ahead.
Yeah, I was simply saying that we're in a very conflicting environment at this point in time. So, see, with regard to liquidity, actually, if you look at the month of April, May, generally you see liquidity actually improving on a seasonal basis. As we stand today, for yesterday, liquidity actually was as low as 0.2% of NDTL, which shouldn't have been the case had there been RBI dividend, which could probably push it up. Plus the swap that the RBI did, a USD INR swap, that also should help liquidity at the margin. But I think the clear question mark remains whether what signals the Reserve Bank is actually sending at this point in time, because we are in a conflicted situation where on one hand we are seeing the Reserve Bank supporting the market on liquidity front to whatever extent it should or it would. On the other hand, there are also chatters about the Reserve Bank probably considering rate hikes, which I think is not our base case either at this point in time, because we believe from the central bank's point of view, while on a logical basis, rate hike would help more to contain demand, which probably will be the need of the hour if this energy crisis continues, but shouldn't be the case for us to really consider as a INR defense. That may not necessarily work for us. If the Reserve Bank is tightening rates, probably to keep in mind the fact that we need to reduce demand because we don't have much of sources with the current energy crisis that the world is facing and we are facing as an economy. The only way for us to counter would be having relatively tighter fiscal and monetary policy. That is the consideration. I would probably understand from their policy. That is the consideration. I would probably understand from their point of view, but from the currency management point of view, I think the rate hike would not necessarily help them. We saw that in 2013, it didn't really help. Yeah. It may not help again as well.
Okay, so if there is a hike, you will look at it as controlling aggregate demand so as to keep inflation within limits and not necessarily as a currency defense. Well, we have an ex-RBI person joining us, Dipali Pant, former ED with RBI. Dipali ji, thank you very much indeed for joining us. Dividends.
If you call me Dipali ji, I'll have to say Latha ji.
No, don't, please. Okay, Dipali.
We are very old. We are old warriors together.
No, Dipali, let's stick to the knitting. Do you think this is excessive or in line with expectation or in line with the budgeted number? And any read-through from this to the RBI policy?
Yes, absolutely, Latha. I would just like to remind you that the RBI was nationalized in 1949 and, as you know very well, set up in 1934. And it was set up to regulate the issue of banknotes and the keeping of reserves with a view to securing monetary stability and to operate the currency and credit system to its advantage. And that is precisely what it is doing. So it is just transferring to Caesar that which is Caesar's. The dividend comes from the income of the Reserve Bank. The income of the Reserve Bank has been good. And we have a lot of gold which has appreciated. Now, your second question was, so I think this is very kosher and very good. And now your second question, Latha, was, what do I think about the monetary policy?
I mean, because plentiful liquidity.
I would expect an interest rate hike because of the exogenous factors of increase in inflation, because of, the oil crisis, the Brent crude trading at very high rates, the oil marketing companies bleeding, and because of the supply chain inefficiencies which will accrue, everything, including the price of food grains, is going to go up.
Okay.
And food, you know very well, as Dr. Rangarajan always said, inflation is a tax on the poor. And to maintain monetary stability, it is very necessary for the Reserve Bank to, and it's its primary dharma, to control inflation.
Okay, let me
and
just...
therefore, a rate hike to me seems very much enough.
Fair enough. Let me just toss that to Madan as well. I wanted to get his view on what to expect from RBI. See, on May 18th, the governor intervenes in IMF to say that central banks raise rates, don't raise rates when there is the first round of inflation because of supply side reasons. Central banks raise rates only when it generates a second round of higher wages, higher transportation costs and the generalized inflation. These are his very words almost. So, Madan, what on June 5th from the Reserve Bank?
So on June 5th, I think it will be a pause, because I think if you look at the past commentaries of the MPC, you're normally looking at what is the prevailing inflation rate, which is, say, 3.5%. That's the number which they'll be having. So therefore, there would not be any reason for them to increase it. Now, we all know, and I think the general consensus is that inflation for the year is going to cross 5%. That would very much still be within that band of 4 to 6%. So therefore, I think while we do expect, or even the market expects, if we look at the OIS market, that we're looking at 1 to 2 rate hikes during the course of the year. It's not something which will be implemented in June. Because right now we're talking of maybe slightly speculative that we think inflation is going to pick up, but we don't know what's going to be the course. But at a very theoretical level, Latha, I think it could be a new way of looking at policy in case they do increase it now, saying that we do expect inflation to be at 6% or 7%, something very high, and to preempt it, we're doing it. But so far, if you look at the forecasts which are given out for inflation for the 4 quarters, none of those numbers in the past, or probably even what they will be giving revised numbers this time, would be warranting an action to be taken at this point of time.
Okay, fair enough. I think that's a fairly exhaustive comment we have got from 3 experts, Dipali Pant, Madhavi Arora and Madan Sabnawis. Thank you very much indeed for joining us.